Good afternoon, everybody. Today is Friday, March 1st. I'm Andrew Packer, editor at Newsmax, welcoming all of you to our monthly financial brain trust call. I'd like to welcome all of our Alliance subscribers to the live call who are dialing in right now. If you would like to ask a question for our special guest this month or any of our brain trust members, you can hit *3 to be connected to a call screener. Please remember that these calls are being recorded. If you're not speaking, please put your phone on mute to minimize background noise. As always, please speak clearly and say your name when you first start speaking. This month, it's my pleasure to introduce William Isaac. William is perhaps best known for his tenure at the Federal Deposit Insurance Corporation, the FDIC, between 1978 and 1985, serving under two presidents. He was also chairman of the FDIC throughout the banking crisis of the early 1980s. Currently, he is a senior managing partner of FTI Consulting and a chairman of Fifth Third Bank Corp. So at this time, I'd like to turn things over to William Isaac to talk more about the current state of the economy and with a focus on how things are going along in the financial sector. William?
Thanks, Andrew. It's good to be with all of you. I'd be happy to talk real briefly about the financial sector and the economy to some extent, and then come back to you for wherever you want to go from there. The financial sector obviously is doing much better today than it was 3 or 4 years ago. With each year, it's getting better in terms of capital and liquidity and earnings. Much of the earnings improvement has come from reversal of the over-reserving that was done during the crisis, so we can't do hand flips over the earnings improvement yet. It's a very tough climate for the banks to earn money. The very, very low interest rates, very tight constraints from the regulators on what loans they would like to see made. So banks aren't able to take a lot of risk. The interest rates are very low, and there's a heavy competition for the loans that are available. And so it's very, very, very difficult for banks to earn money, to fatten their net interest margin. They're doing it. I mean, they're making money, but it's a real struggle. They're having to watch their expenses and cut their expenses very sharply. They're having to be very, very careful about what kinds of risks they're willing to take, and they're just having to be much smarter about how they run their business. The economy is. I'm pretty pessimistic about the economy myself. I know it's coming back. I know it's stronger than it was a 3 years ago, but I'm very concerned that much of what we see in the economy is not necessarily real. It's been driven heavily by fiscal policy, the massive deficit spending, and it's been driven greatly by monetary policy, the Fed with QE2 and the amount of liquidity it's pumped into the system and the way it's keeping rates down so low. I really think a fair amount of the growth is. I don't have confidence it's being reflected in true activity in the private sector as opposed to massive pump priming by the government, which can't continue forever. The Fed can't keep on doing what it's doing forever, and the Congress and administration can't keep on spending the money they're spending forever. So at some point there's got to be some day of reckoning, and that makes me very nervous for the economy. We're not really addressing the fundamental problems that we face, and so that doesn't inspire a lot of confidence on my part. I think it's a time to be very careful, particularly with the stock market up the way it is. For me, it's a time to be careful and cautious about what you do with your money. Maybe I'll stop there and see where we want to go.
All right. Well, thank you for that kind of brief overview. I do kind of have sort of maybe just a quick question for a lot of our listeners. As the former chairman of the FDIC, I know during the financial crisis they kind of stepped up a lot. They significantly increased the amount that they would insure bank accounts for, things like that. They have talked about scaling it back, but haven't really done much in there. Would you be looking for something like that as a sign that the financial sector is getting kind of healthier and can step back from a lot more implicit government guarantees?
The government recently allowed the TAG program to expire, which was the transaction account guarantee. During the crisis, the government stepped up and guaranteed 100% of all non-interest-bearing transaction accounts, in other words, checking accounts. That was allowed to expire. Some of the community banks argued that they would really be in a lot of trouble if that were allowed to expire. They'd lose a lot of their deposits. It appears that's not happening, that the community banks are doing just fine right now with their deposits. The other thing they did during the crisis was they increased the deposit insurance limit from $100,000 to $250,000. They said that was to be temporary. I never thought it could be temporary, that once you increase the deposit insurance limit like that, you're sort of stuck with it, and they wouldn't have the courage to ever roll it back. They haven't rolled it back, and I don't think they will.
All right. Well, thank you for that input and sharing your views. I'd like to go to one of our Brain Trust members now, John Brown, for his take on the financial markets. John?
Oh, well, I'm afraid I hate to be so pessimistic, but I entirely agree with William. I mean, I think I'm pessimistic, both because of the unbelievable amount of government spending, which I think is totally irresponsible. And listening to the President just a few minutes ago, it's incredible how irresponsible it is and how he's trying to shift the blame, taking no responsibility at all. I think I totally agree that QE, quantitative easing, cannot go on forever. And I'm also pessimistic because we're not only living on a false money basis that this implies, but also false statistics. I mean, a week or two ago, you had John Williams on here, who calculates government statistics on a pre-Clintonian basis. I tend to agree with him more. I mean, here we've got people being misled in every single direction. And the chairman of the Fed at the recent senatorial examination the other day was really quite arrogant as the way he turned to a senator and said, "Your figures are wrong." Having been on the Treasury Select Committee in England in Parliament, we would have never put up with that sort of accusation to a member of the committee, and all the people being examined realized it. They would have been a hell of a lot more polite than Mr. Bernanke was to that senator. I now see the banks even bigger than they were before, and as William was saying, they're having problems in keeping net interest margin, etc., and cutting costs. In effect, a lot of that cutting of costs, it appears to me, is passing on the cost to the customer. And I'd be interested in his views on that. And I'd also be interested, as they've gotten bigger, in his views on living wills. I notice in the Financial Times of yesterday, there was a major article on the front page about these living wills, and interestingly enough, the FDIC, according to the Financial Times, was more robust in the debate than the Fed. I can understand why, but I'd be also interested to hear William's views on that. And looking at the pessimistic view, as he and I apparently share, at least in outline, to the future, in the stress tests on the banks, a collapse in the Treasury market was not included, and I'd be interested to hear his view on the banks if there was a collapse in the Treasuries, which I believe is the biggest bear trap that we face. And finally, having said all that, I would be most interested to hear his views on Glass-Steagall, which I personally think is essential to make the banks real banks, because they're in these privileged positions. No matter what people say, the banks are going to be privileged because no nation can afford its banking system to collapse. So they're going to have to be protected one way or the other in general. And in return for that, I think they should be restricted merely to commercial banking and not allowed to get into investment banking and speculative investments on their own account. And I'd be most interested to hear his views on those points.
Sounds like a long list of questions. William, is there anything you'd like to cover first?
Somebody would ask me those one at a time. They are very good questions.
Okay, well, the first thing is living wills. I'd be most interested to hear your view on that.
Living wills. I believe that living wills is one of the few things to come out of the Dodd-Frank reform law that has any hope of actually improving the supervision and regulation of banks and the handling of failures. I'm not optimistic that it will, but because I'm not optimistic that the regulators will get it right. But when I was chairman of the FDIC, one of the really serious issues we had was that we had no idea what was going on in the big banks. And Continental Illinois, which was the 7th largest bank in the country at the time, was thrust on us without any notice. And we had to figure out how to resolve it without knowing anything about what was going on in the bank and how it was structured, what it was doing, and so forth. And it's probably only gotten worse today because the regulators aren't even doing full scope exams in the big banks. They're doing targeted exams of specific areas of the large banks on a more or less continuous basis. But nobody's really taking a snapshot, a picture of the whole thing at the same time. So it's really hard. It's hard for me to imagine that anybody has a clue what's going on in the biggest banks, perhaps including the boards of directors of those banks. The living will, I'm hoping that the regulators will get it in digital form. The first round with the major banks was done in paper form, PDF truckloads of documents being sent to the regulators. That's useless. The regulators don't have the staff to go through those and figure out what's in them, and to compare one bank against another. There's not a common reporting format or anything. I believe that if the regulators got serious about the living wills, required the banks to be sending that information in digital form on a real-time basis in a common format, so the regulators can take a look at the whole industry and individual institutions in that industry and compare them at any time, then I think we've given the regulators the kind of information they need to properly regulate these institutions and to resolve them in an intelligent way if and when they start to fail, and hopefully catch the failure long before it occurs and make some changes, order some changes so that the banks won't actually fail. So I think that there's a potential there with the living wills, if they are truly living, breathing instruments. If all this is a paper-based plan for burial, then it's worthless. But if it actually is a living, breathing, digital set of information about all the major banks in the system, then I think it could take bank regulation and supervision to a new level and bring it into the modern era.
And just apropos of that, what do you think about the risks in the treasury market to banks? I understand that a collapse or a serious fall even in the price of treasuries was not included in the stress test, and the banks appear to have invested very heavily in treasuries and are therefore vulnerable to such a fall.
Well, I heard you ask that earlier, and I was having actually some trouble understanding how that comes about. What causes the treasuries to fall considerably in value? Are you saying rates go up? Is that what you're predicting?
Yes. I mean, okay. I personally think, and this may be extreme to you, but I think there's going to be this will end unhappily because there's not a political will to correct it in a crisis of currency. First phase, you will see a flood into the dollar, and then I believe a lack of enthusiasm for fiat paper, and with that, interest rates will be forced to rise, and with a rise, a severe erosion from these falsely low rates, thanks to QE, and therefore a bigger drop in treasury prices, and what an impact that will have on banks.
Okay, well let me take a stab at it. I don't believe that the banks, at least the banks I'm familiar with, I don't believe that they are heavily invested in longer-term treasuries. I think they have kept their maturities short because the banks do expect that we are going to have a rising rate environment. It's hard to imagine we could have anything but a rising rate environment, at least in terms of where our current policies. And so I think we're headed toward a rising rate environment. I think most banks anticipate that and have structured their assets and liabilities to take advantage of that. So I don't believe that a rising interest rate climate is going to be bad for the banks. I think most banks will benefit from it significantly.
I see. How interesting. What about Glass-Steagall Act? What do you feel about that?
That's a tricky subject that I've had different opinions on at different times in my career. When I was chairman of the FDIC, I actually was in favor of getting rid of Glass-Steagall. I thought it was an artificial barrier between investment banks and commercial banks that was retarding competition and keeping these institutions from providing more services at better prices to more people. So I actually thought that was a relic of the Depression that we should get rid of, and I argued for it. Then I watched this crisis occur, and basically the crisis primarily affected Wall Street, not commercial banks. The crisis started on Wall Street, and the only commercial banks that really got caught up in it were banks that had become very investment bank-like. Citibank, for example, looked almost more like an investment bank than an investment bank, and so anyway, my view began to change that saying that Glass-Steagall repeal was a mistake. I thought we had the ability to regulate these firms better than we do, and I regretted that we had Congress in 1999 had repealed Glass-Steagall. I've since thought about it a lot, and I'm coming around to this conclusion. I believe that one of the riskiest things that commercial banks do is to underwrite and make commercial loans and hold them on their books. That is probably the most. I think it is the most risky thing commercial banks do, and I look at that compared to underwriting corporate bonds or stocks, being an underwriter and offering those out to the public. And I think that is a far less risky activity than actually making a loan to a corporation and holding that loan on your books, the credit risk, the interest rate risk, and so forth that you're taking. So it seems to me that I'm not troubled if we have commercial banks acting as underwriters of stocks and bonds, as long as they're doing it intelligently. They have the management to do it and so forth. But it seems to me it's less risky than their main line of business, which is to make commercial loans. Where the problem comes in is when commercial banks start acting like investment banks by trading securities and other instruments. And J.P. Morgan Chase, for example, lost $5 or $6 billion on that within the past year because somebody was making trades they didn't understand and apparently didn't even know what was occurring. So I've come to the conclusion that if we're talking about reimposing Glass-Steagall in the sense of getting commercial banks out of the underwriting business of stocks and bonds, I think that's probably a mistake, because I think that's a relatively safe, fee-based activity that could be very profitable to the banking industry and give them ways to not have to take so much risk in underwriting and holding loans on their books. So I think it probably reduces risk in the banking industry. But if we're talking about the aspect of investment banking, of proprietary trading stocks, bonds, derivatives, and so forth, and trying to basically bet the bank's capital on it, I think we ought to tightly limit that, if not just eliminate it. I think that trades on behalf of customers are one thing. I don't have any problem with that if they truly are on behalf of customers. I think that hedging risks that are in your portfolio, I don't have any problem with that. But if you're trading as a profit center, I don't think that belongs in a commercial bank.
I totally agree. I'm having experience. When I first went to Morgan Stanley in 1969, Henry Morgan, J.P. Morgan's son, was our first senior partner. We, of course, were tightly limited in that lending by the Glass-Steagall Act, and we sort of got round it for the Eurobond market by having this company in Paris, and J.P. Morgan, through an EDGE Act company, was a great thing of Morgan & C in Paris, which enabled J.P. Morgan sort of slightly get round it, do exactly what you're saying, which is to underwrite bonds. In fact, they had to be Euro bonds, of course. One saw that happen, but then when the Glass-Steagall Act finished, Morgan Stanley got into trouble by being bankers as well as investment bankers. And it all, but I think your view, I totally agree with your view that underwriting of bonds is not the risk, but the trading is. And I totally accept your view. Thank you very much.
Mm-hmm.
All right. Thanks, John. Thanks, William. Appreciate that. Do want to get to some of our other Brain Trust members who have questions. I believe Barry Elias asked to contribute next. Barry?
Oh, hi, Andrew. Thank you. Thank you very much, and thank you, William, for the presentation. And I, too, agree with your last point very strongly, where the banks are using their capital reserves to go forward with that speculative activity, and that's the real crux of the matter. And I was interested in asking something about monetary policy going forward. Do you think it would be more prudent, the same way banks hold capital reserves to protect against risk, if our currency had capital reserves to protect against risk, and specifically if we should back our currency by some form of real tangible assets such as gold and silver? Do you think that's a prudent move?
I am not an economist. I've had economics courses, but I don't consider myself an economist. And I really think that question is above my grade level. I would say, though, that I am very concerned about what the Fed is doing with its now $3 trillion balance sheet and virtually no capital. It's hard for me to imagine that rates aren't going to go up, and the Federal Reserve is sitting on a lot of long-term MBS and government bonds, as I understand it. I don't know what happens to our Federal Reserve when rates go up. I mean, I guess they don't have to observe mark-to-market accounting rules, but if they did, they'd be gone. And so I'm very troubled about this policy that the Fed is pursuing. I think it's very harmful to our society. We have a very large class, the baby boomers, who have worked all of their lives to save money for retirement, and the Fed is holding interest rates at close to zero. These people can't find any way to earn money on their investments, their savings that they've spent their whole life building. They can't find an adequate way to earn money on those savings to allow them to enjoy their retirement. A lot of them are staying in the workforce, and I mean, I see it all the time. I see people who are way past retirement age in my own firm, for example, who are staying because they really can't afford to retire based on the climate we're in. And what that does is it clogs up the workforce so that people coming out of college can't find jobs. And we have very, very high unemployment among our younger people, including particularly minorities. And so I think this policy is very, very harmful. I think it's disquieting in terms of business people trying to make decisions. The Fed is telling us that for 3 or 4 years it's going to keep rates at near zero. One message that's sending is we think the economy is in really bad shape, such that it needs 0% interest rates for the next 3 or 4 years. That doesn't inspire confidence when you're deciding whether to go out and buy something or invest in something. The other thing it does is it reduces the urgency people might otherwise feel to borrow. Why do I need to borrow right now at these low rates, which I would normally do if I didn't know what the Fed was going to do tomorrow? Normally I'd go out and grab all the money I could grab at these low rates so I could get those rates locked in. Now they're telling us the rates are going to be down for 2 or 3 or 4 years, there's no hurry to go out and borrow. And so,
yes.
and make those investments. I really think it's having the opposite impact they think it's having.
Yeah, I just want to make one more comment, then I'll let Andrew take it away. I think you said it very beautifully, where keeping the rates low now essentially reduces demand for the future, because I could get cheap money later down the road. And I think that is seriously undermining monetary velocity. We don't need more money supply. We need more monetary velocity to generate income, employment, and even tax revenue based on that employment to reduce the deficit and debt accumulation. I think you're exactly right on that. I couldn't agree with you more. Thanks for your input, and back to you, Andrew.
Before Andrew jumps in, let me make one more comment that's related to this, and that is regulatory policy. Bank regulatory policy must be, if it's done properly, must be countercyclical. We have, over the past 20 years, moved to a point where our bank regulatory system is highly pro-cyclical. And I'll explain that, but you reminded me of it when you talked about the velocity of money. The time for regulators to be tough on the banks, to urge them to or demand that they raise capital, that they raise their reserves, that they tighten their credit standards, is when the economy is overheating, as it was in 2004, 2005, 2006. That's when the regulators should have been pounding on the banks. Today, when we're in a place like we are today, the regulators should be urging banks to lend more money, giving them a little slack on how high their capital needs to be, urging them to go out and make loans and get the economy going and try to get jobs being created and so forth, spurring business activity.
Yes, that's the real economic multiplier. When the money comes in at the beginning of the production process, you get a real robust economic multiplier, as opposed to when the money comes in for consumption-based activity. The multiplier for consumption is much lower than the multiplier for investment.
Right. And what we are doing right now, what the Fed is doing, the government is doing, is it has one foot on the accelerator, i.e. fiscal policy and monetary policy, and the other foot on the brake.
Yes.
And that's regulatory policy. They're telling the banks, you don't have anywhere near enough capital and reserves. Your underwriting standards are too loose. We want them tightened. And so that's the foot on the brake, and it's holding things back.
Yeah.
And so the Fed, the fiscal policy and the monetary policy that are down flat on the board, the accelerator's down flat, they can't go anywhere because the brake's still on. And so they're pumping all this money in, and it's not accelerating. It's not creating economic activity because the banks are all tied up in knots. They can't move.
Mm-hmm. Yeah. Thank you.
All right. Thanks, Barry. Appreciate your input on there. Among
Thanks,
our other Brain Trust callers next, I believe David Nelson had a question. David?
Andrew, thanks so much for letting me on. William, thank you for your very intelligent viewpoint. I've been a real fan for a lot of years. But I have a question. I want to take you to a point that you made about hedging activities within banks, and that you're opposed. If I understand you correctly, you're opposed to letting banks do proprietary trading for their own book, but not opposed to them hedging their book. Now, I've interviewed some of the traders inside these organizations, and sometimes in some cases, the SEC and other regulatory bodies are sitting literally right there on the floor, and they don't really have any idea what these guys are doing. And it seems a very gray area for a banking institution to be hedging. It only takes, a very slight adjustment to a trade to turn a hedge into a speculative investment. I wanted to get your thought on that. And just one last item, if you could elaborate a little bit more about some of the real-time monitoring that you would like to see within the banking industry?
I agree with you that it's very difficult at times to tell the difference between trading for a customer's account and the bank's account, and hedging activity, legitimate hedging activity versus profit-making activity. And I think Dick Kovacevic, who's one of my good friends and probably one of the best bankers I've ever, not probably, he is one of the best bankers I've ever seen in my lifetime. He was the recently retired chairman and CEO of Wells Fargo, and has been successful at operating a bank in good times and bad without getting in trouble, and creating a remarkably successful bank. Dick and I do a lot of writing together, and I think he's just got a world of experience from the CEO side, and so I really respect his opinions a lot. He and I wrote an article recently in which we said you really can't tell the difference in what the bank is doing in many cases. So what there ought to be is a cap on the percentage of profits or revenues that can come from trading activities, whatever they are, whether they're for customer accounts, whether they're for hedging, that you shouldn't be getting more than 10% of, say, your profits from those activities. And if you go over that limit, there should be a presumption that you're not just trading, you're not just doing hedging or trading for customers. You're actually it's a profit center for you, and so we would cap it at 10%. If you're below 10%, the only issue for the regulators were, do you know what you're doing? And if you're losing money, they ought to throw you out of the business because you don't know what you're doing.
Thank you so much for that. I appreciate it.
All right, thanks, David. I wanted to go to one of our subscribers now who, hit *3, talked with one of our screeners, and asked a question. This comes from James. Basically, with kind of all of the pessimism that you see in the economy, what would be the best place to start investing, particularly for somebody living off of a fixed income like a pension? I'm not an investment advisor. I'll just talk about what I do, because I don't advise other people. Sounds perfect.
I am really quite concerned about inflation, and I'm quite concerned about the economy going off the cliff. So I've got the dual concerns in opposite directions. I think that the economy is being revved by artificial devices of fiscal policy and monetary policy, and I worry that when that runs out, the economy is not going to have enough wherewithal to keep on going, that we're in for a long, slow period. And on the other hand, I'm quite fearful that governments around the world will think the only way out of this is to inflate their currencies, and that we're in for a round of serious inflation. I take that very seriously, because when I was at the FDIC, we dealt with trying to bring an end to a highly inflationary period. The 1970s, inflation got out of control, primarily because fiscal policy and monetary policy were both loose from the late 60s through the 70s, and inflation was out of control. Paul Volcker came in as chairman of the Fed in 1979 with the instructions to get inflation under control. He slammed on the brakes, and the prime rate went to 21.5%. And so the rest of the 1980s through the early 90s, we spent, as bank regulators and as the FDIC, we spent trying to clean up the mess. And it was very, very painful for a lot of folks. Can you imagine if you had borrowed to run your business at an 8% rate, and you had that in your business plan, and all of a sudden you're paying 22% or 23% interest rates? Or if you borrowed money to buy the family farm at 8%, and now you've got 22% interest rates. It really caused problems throughout every sector of the economy, far worse than in the past couple of years. There was a depression in the agricultural sector. The energy sector collapsed. The FDIC was one of the largest owners of oil rigs at one point, and if we were lucky, we could get 10 cents on the dollar for them. There was a rolling real estate recession that took down major banks and S&Ls all over the country. 9 out of the 10 largest banks in Texas, for example, failed during this period because of the real estate and energy problems they had. Our money center banks were loaded up with sovereign debt to lesser developed countries. They were in such bad shape that we had put in place a standby plan to nationalize all the banks if these countries had defaulted on their debts and renounced them. The Fed and the FDIC and the Treasury had developed a plan that we would have used, and we would have been forced to nationalize all the major banks in the country had the LDC loans defaulted. The thrift industry collapsed. The FSLIC went broke. It was a terrible, terrible period, far worse than anything we've seen in the last 5 years. We were able to contain it, but I sure wouldn't want to go through it again. Now, the question was about investments, and so I wanted to give you all that background to tell you why I'm generally an optimistic person, but right now I'm very cautious. And the thing that I'm highly liquid. I paid off all my loans a couple of years ago, and when I do make investments, they tend to be in income-producing real estate. Income-producing real estate I like because if we have inflation, the rent's going to go up, and the value of the building's going to go up, and I'm protected against inflation. I'm getting rent, so I'm getting some current income, and much better income than I could get investing in stocks or even bonds. So I like that, but if you're going to own real estate, you obviously have to be highly liquid because you got to be able to hold it. You can't sell it overnight, and so that's my own personal approach, and that works for some and not for others. I don't know what you'd do if you aren't willing to take those kinds of if you don't have the liquidity or an understanding of real estate and the ability to do that. I don't have any good advice except please be careful.
All right. Well, thank you very much for that. Appreciate that, and thanks for calling in and asking that question, James. I'd like to go back to our brain trust, see if anybody else had any questions for our guest today, William Isaac.
Yes, could I just ask one question? It's John Brown speaking again. Apropos of William's last excellent reply to the investment thing and what he does himself, could I ask what he thinks about precious metals in view of what he said about the future, which looks like stagflation, economic decline, and financial inflation?
I'm glad you mentioned the word stagflation because that's what this feels like to me right now. It's what we experienced. That was a term that was coined to describe the late 1970s, stagflation, stagnant economy accompanied by growing inflation, and that's what this period we're in right now feels like. I've never been a fan of commodities and gold and so forth. I know a lot of people are, and I'm not trying to say they shouldn't be doing what makes them comfortable, but I've never liked it because I can't eat it. I can't get any income off of it. I'm simply betting that the price is going to keep on going up, and I don't like that kind of bet. In comparison with commercial real estate, I actually have a use for it. I mean, or it could be a residential house that I'm renting. By the way, it doesn't have to be commercial real estate. With real estate, there is a use for it, and you are getting income off of it, and it will inflate if there is inflation in the economy. So I'm more comfortable with that kind of bet personally than I am with just owning a commodity or a grain or whatever it is that you're betting on the price going up because that may or may not happen. because
but William, would you agree that if one takes a difference between income and capital gain, it's really largely for tax purposes. If you look at the investment from a total return point of view, if the price of an item, whether it's real estate or whatever, gold or whatever, goes up, surely you can take income out of the capital appreciation.
You can if the price goes up, and what I'm saying is that if the price goes up, it was a good bet, obviously. But if the price doesn't go up,
but even if the price goes down, you can take income. What would amount to income? You can sell some of it, even at a loss, to provide your income needs out of a total return. It happens to be a negative total return for that year, but it doesn't mean to say you can't sell any of it to provide income.
No, I understand that. I understand you can sell it. I'm just saying that if I keep money in a bank account, that's safer. That's less risky than buying gold. Now, it doesn't have the upside. Gold could go up, and a bank account's not going to go up, but you're just going to get a little income off of it. But a bank account's not going to go down, and gold could. And so that's...
a bank account is not going to go down in capital terms, but if you believe John Williams' statistics, a 0.5% return in a bank account today is actually a negative return of 5.5%. So whilst the capital is not decreasing, the income is a negative 5.5%.
I agree. I know that some people like to buy gold. I'm just speaking for myself. I don't. To me, it's a one-sided bet. There's no. If I were to buy gold, by the way, I like gold coins, and I'd have them as a collector just because it's kind of fun to own a double eagle or whatever. But I think that from my point of view as an investor, I don't like to bet on. A lot of people play the horses, and some people are good at it and they can make money at it. I never could, and I think that gold is something that it's influenced by a lot of things I have no control over, and I worry that the only way I can get any income out of that, there is no income. The only way I can make any money is if it goes up, and if it doesn't go up, I'm stuck. I'm either going to break even at best or lose money. I'm not saying it's illiquid. I know you can sell it. But anyway, that's just my personal view, and other people have a different view of that because a lot of people buy gold, and a lot of people are successful at it. It's just not my cup of tea.
Thank you.
All right. Thank you, John, for that. Actually, as long as we're talking about specific asset classes, I also have a question. Back in September 2008, kind of at the height of the financial crisis, we saw a lot of money market funds break the buck, where they traded below sort of their par value of $1 on, supposedly, riskless assets. Is that something that we could be seeing again soon, or is this a problem that's kind of been solved that we don't need to worry about when we're parking kind of our short-term capital?
I don't think we have solved the money market fund issue yet. I think there are moves underway to try to change the way that money market fund industry works so that we don't have that problem again. But to my knowledge, they haven't fixed it yet. I know the SEC's had proposals out, and they've been highly controversial, and I don't think they've done anything about it yet. But I may be wrong on that, but that's where I thought it stood as of a few weeks ago at least.
Okay, thanks for the input on that. Going now to another one of our Alliance subscribers who is called in and screened by hitting *3. We've got Wayne who asks, based on the amount of money being printed by the Fed, have we gone too far to consider a reasonable exit strategy? And if not, what would that exit strategy look like?
I don't know whether we've gone too far to certainly we've not gone too far to consider an exit strategy. We ought to be thinking hard about an exit strategy. I don't know whether we've gone too far to have a decent exit strategy. I've given some thought to that, and I've had conversations about it with people, trying to figure out what exit strategy does make sense. I mean, let's assume that rates do go up, and the Fed has $2 trillion of long-term assets that are going to go down significantly in value because rates are up. And let's just take a stab at it and say that the Fed's portfolio, instead of being worth $3 trillion, is worth $2 trillion. How would you deal with that? If that were a private company, it would be out of business. It would be in bankruptcy because it would get marked to market. It would have negative net worth, significant negative net worth, and it would have to shut down and be reorganized, and the creditors would have to take losses. It's not a private company. I don't think it's subject to mark-to-market accounting rules, and it seems to me that the exit strategy could be that the Fed just sits there and lets those portfolios wind down, holds them to maturity, basically, and winds up getting the face value back, the notional value back of those instruments, but not making any money for a period of years. I mean, right now the Fed's making, I think it's something on the order of $100 billion a year, maybe a little less, and it's turning that money over to the Treasury. The Fed will just stop making money for a number of years, and the Treasury will stop getting money from the Fed, and the Fed will just let that portfolio wind down, and there will be no consequence other than a lack of income at the Fed and a lack of flexibility at the Fed to do anything because they don't have any capital.
William, may I ask a question on this income from the Fed? You say $100 million. I totally agree. No reason to dispute that. But they're giving money to the Fed. How much money is going to the owners of the Fed, which is not the Treasury?
Well, I think it was you. I think you just accidentally said $100 million. It was $100 billion, I think.
Oh, sorry, it's 100.
But in any event, the owners of the Fed. I mean, we have banks that invest in Federal Reserve stock, but I think the income they get is minuscule on that. So I don't think that's really an issue. The Fed's profits routinely are turned over to the Treasury, and the Fed almost always makes a profit, and so the Treasury counts on that income. But so one way the Fed might manage this is to simply hold the assets to maturity and wind up getting the full face value of the assets back, but a significant loss of income for quite a number of years. Another thing that has occurred to me with respect to Treasury securities that the Fed holds, it's got a bunch of long-term Treasury securities. One thing the Fed, and I mean the Fed is part of the government, one thing the Fed and the Treasury might do is agree that the Treasury will exchange short-term Treasury notes, shorter-term Treasury notes for all the long-term stuff the Fed is holding, and do it at par. In other words, the Fed wouldn't lose money in that trade. The Treasury would simply substitute much shorter-term U.S. Treasuries for the longer-term Treasuries the Fed holds. That's another thing they could do. I don't know what they do with their MBS though, because I don't know who's going to make that swap. So,
but William, you say the Fed is part of the government. I thought it was supposed to be independent of the government and is indeed privately owned.
It is supposed to be independent, politically independent. I question how politically independent it's been in recent years. But it's supposed to be politically independent. I don't believe that it is, in fact, economically independent. All of the Fed's profits go to the Treasury, and so it's not really a private sector business. But it's a fascinating question and a tough question.
Particularly when there's no audit.
Right. What's the Fed going to do when rates go up, which they must? The Fed can't stop rates from going up once they decide they're going to go up. Once the inflationary fears set in, economic activity picks up, rates are going to go up whether the Fed likes it or not. And so what's the Fed going to do when that happens? What's the exit? And I've come up with a couple of ideas on what might be done, and I suppose many of our listeners today probably have other ideas on things that could be done, but those are the only two that I've been able to come up with.
Yeah, I have a question. This is Tom Hutchinson. My question is on excess reserves, which is my understanding that through the quantitative easing, the buying of the bonds, the banks have a lot of this cash sitting in excess reserves. Now, could those make it into the money supply, and what's that money doing while it's sitting there?
Well, the banks have, let's just say a trillion. It's somewhere between $1 trillion and $2 trillion of excess reserves, but let's just say it's $1 trillion. The banks have $1 trillion of reserves, more than they need. What they could be doing with it is using those reserves to loan a lot more money to their customers. The problem with that is they can't right now because regulatory policy is so stringent. The regulators are requiring the banks to maintain ever higher capital ratios, and they're requiring them to tighten their credit standards so that they're not able to take any significant credit risk. So that's what I'm talking about, where earlier when I said they've got one foot on the accelerator and the other foot on the brake. Right now there's nothing that can, the reason why that money isn't being loaned out is it can't be. The banks would dearly love to loan out more money than they're loaning out because that's how they make money. That's how they get the net interest margin up. And right now they can't loan money because there's a very limited number of loans that they can make in light of the credit underwriting standards that the regulators are holding them to and the capital requirements that the regulators are holding them to. So that money right now sits pretty much idle. The banks make a little bit of money off of it, but not much. And and that's why a lot of people think that our current QE2 policy, or the Fed's current QE2 policy, is like pushing on a string. They can keep on pumping that money out, but it doesn't go anywhere because it just sits there idle.
I think that this is Barry Elias. I think that might be another reason for why they're not lending out the excess reserves, because I believe for some time the Federal Reserve has been guaranteeing a certain percentage return on that money, maybe like 0.25%, even though that's small. It's guaranteed money, and they don't have to take risk. Is that accurate? What I've just mentioned?
I don't think banks are in the business of making 0.25% or 0.5%, even on riskless money. I think they'd like to have a net interest margin between 3% and 4%, in which there is some risk that they can evaluate. That's a much better place for a bank to be economically. Getting 0.5% on riskless money is better than getting nothing, but it's not where the banks want to be.
Yeah.
All right, well, we're getting kind of near the top of the hour, so if there are any other questions from our Brain Trust members, I believe we have time for one more there, and then one more from our subscribers who've called in.
Well, I had one other question, if I may. This is Barry again.
Sure.
Oh, okay. William, getting back to gold and silver, not from an investment standpoint, but it seems like having gold and silver as a backing to the currency would maybe be less risky in terms of unfettered and undercapitalized fiat currency creation by the Fed and other sovereign countries, where it's backed by a commodity that represents the real productivity of society, because it could cost maybe $500 an ounce to get gold out of the ground, and that would represent, a good use of labor to produce that and be reflected in the economy rather than simply printing the money, which can be done with virtually zero marginal cost and can actually distort the allocation of resources.
I know they're there are people who believe that, and as I said earlier, I'm not an economist, and I think that's really above my grade level. I know we had the gold standard, and I know that we uncoupled from it, and other countries have uncoupled from it, and I just don't feel confident to comment on what would happen if we tried to go back to the gold standard or silver or whether some other form of backing for the currency. That's just I just don't feel that I have the expertise to be commenting on that intelligently.
Okay, thank you.
All right, and before we wrap things up, I've got another question from our subscribers who have called in today. And again, you can hit *3, talk to a screener, get your questions. If we don't answer them during the call, I can always get to them in next week's weekly email update. But this question comes from Frank, who wants to ask about real estate, which is if you don't have the liquidity to outright purchase real estate, how would you feel about real estate investment trusts as an alternative?
I think real estate investment trust is a good alternative, and if they're good, you have to know what they're investing in. But I actually have thought about that. I come from a real estate background, so I have some ability to do it myself and without having to go through a real estate investment trust. But it strikes me that investing in a high quality real estate investment trust could be a good way to go if you don't have the real estate expertise and you want to invest in real estate. I think that's an excellent idea.
Okay, well, thank you very much. We're getting on the top of the hour, so time to wrap things up. I'd like to thank all of you for joining today and sharing your ideas. As always, for our Brain Trust members, if you have any input or heard anything worthy of a discussion, please feel free to send your thoughts around via email. We'll be having our next call on Friday, April 5th, and I will have more details out to you as that approaches. Thanks, everybody, and have a great month.